This didn't happen slowly. It happened in the third quarter of 2025, and almost no one noticed. Officially, we were told that gold ES price surge is just another cycle in a volatile commodity market. The price is hovering around $4,500 per ounce. The market is functioning, and nothing is wrong. But there's a detail that doesn't fit, and it's been quietly removed from the conversation. On September 30th, 2025, the World Gold Council reported that central banks added a net 10 tons in July alone. But the year-to-date figures told a different story. Over 1,000 tons purchased globally for the third consecutive year with no major sellers in sight. Behind the scenes, the People's Bank of China extended its buying streak to 13 months, adding 4.98 tons in Q3 without fanfare. Not announced, not explained, but irreversible. One action, continuous accumulation. One consequence, permanent reduction in available supply for private markets. On screens, gold is $4,500. In the real world, physical premiums in key markets like Shanghai and Mumbai have spiked to 5 or 10% above spot, if you can even find it in volume. Trading halts on futures exchanges occurred twice in October 2025 amid volatility. Delivery delays from major vaults stretched to weeks. Premium spikes hit record levels in Asia. Inventory disappearance became evident as COMEX registered stocks dipped below 20 million ounces. This would be manageable if demand were falling. But it isn't. Central banks alone absorbed over 850 tons through Q3 2025. EVs require gold in electronics. Solar panels use it in conductive layers. Military applications demand it for reliable circuitry. Grid infrastructure incorporates it in high-voltage switches. AI infrastructure relies on it for data center cooling and connectivity. These systems don't wait for price discovery. This is where banks usually intervene. They cap the move, they calm the market. This time, they didn't. Position changes. Central banks shifted to net buyers exclusively, with Poland adding 83 tons year to date. Silence from traditional sellers like the IMF. Rule change. No new sales agreements announced. Sudden compliance with diversification mandates. Once physical delivery failures exceed 5% of contracts, the system can't go back, not because of price, but because of trust. Supply exhaustion in above-ground stocks. Delivery failure in key exchanges. Political interference in export controls from major producers. We've seen this before, not in gold, but in the 1971 Nixon shock, closing the gold window. The question isn't if the price moves, it's who still has access when it does. Markets don't announce resets, they signal them quietly. This was one of those signals. If you're watching this, you're early. The shift in central bank behavior didn't emerge from a vacuum. For decades, these institutions balanced their reserves with a mix of currencies, bonds, and gold, often treating the yellow metal as a relic to be managed rather than hoarded. But something changed in the early 2020s, accelerating through 2025. Geopolitical fractures, starting with the Russia-Ukraine conflict in 2022, exposed the vulnerabilities of dollar-denominated assets. Sanctions froze billions in Russian reserves, proving that even sovereign holdings could be weaponized. Central banks in emerging markets took note. China, already diversifying since the mid-2010s, ramped up purchases. By 2025, its official reserves climbed steadily, with monthly additions becoming routine. India followed suit, tying gold buys to de-dollarization efforts. Turkey, facing currency pressures, used gold as a stabilizer. Even Poland, in the heart of Europe, led European buyers with aggressive accumulation. This wasn't speculation, it was strategy. Gold has no counterparty risk, no issuer to default, no government to sanction it. It can't be printed endlessly like fiat currencies. In a world where U.S. debt surpassed $35 trillion and inflation lingered despite rate hikes, gold became the neutral asset. Central banks weren't just buying, they were refusing to sell. Historical data from the World Gold Council shows that from the 1990s to the early 2010s, central banks were net sellers, offloading hundreds of tons annually to fund operations or stabilize currencies. The central bank gold agreements, signed in 1999 and renewed periodically, capped sales at 500 tons per year to prevent market crashes. But by 2019, those agreements expired without renewal. Sales dried up. In 2022, net buying hit a record 136 tons. 2023 and 2024 followed with over 1,000 tons each. By 2025, the pattern solidified. No significant sales reported, only additions. Consider Kazakhstan adding 41 tons in 2025, or Brazil with consistent quarterly buys. These moves weren't flashy announcements. They appeared in IMF reports months later, buried in data tables. The suppressed detail? The aggregate impact on global supply? Above-ground gold stocks total around 200,000 tons, but mine production adds only about 3,000 tons yearly. With central banks absorbing a third or more of that, private demand, from jewelers in India to investors in the West, faced a squeeze. Physical markets fragmented. In Asia, where cultural demand for gold remained strong, importers paid premiums unseen since the 2013 taper tantrum. Dealers in Mumbai reported wait times of up to a month for large bars. In the US, coin shops hiked prices for eagles and maples, citing supply chain delays from refineries. The official story painted this as a bullish but orderly market. Analysts at J.P. Morgan forecasted gold at $4,000 by October 2025, citing trade concerns and inflation. They got the direction right, but understated the velocity. Gold climbed 55% year to date, surpassing $4,000 for the first time. Bloomberg noted central banks as the biggest force in a secular gold bull market, driven by post-Ukraine shifts. Yet, mainstream coverage focused on spot prices and ETF inflows, ignoring the back-end mechanics. SPDR gold shares saw $82 billion in net inflows, pushing holdings to record levels. But behind that, COMEX inventories dwindled. Registered gold, eligible for delivery, dropped sharply, triggering concerns about a potential squeeze. This disconnect manifested in subtle ways. Futures traded at discounts to physical in some sessions, an inversion signaling stress. Options volatility spiked, with implied vols hitting levels last seen in 2020. Traders whispered about backwardation in forward curves, where near-term prices exceeded futures, a classic sign of scarcity. The leak came from insiders. A Wisdom Tree report in September 2025 highlighted gold's 30% plus surge as reshaping its role from slow-moving to essential. OMF-IF surveys showed 68% of central banks storing gold onshore, up from 50% in 2020, indicating a preference for control over yield. No one announced a stop-selling policy. It just happened. Positions changed quietly. The ECB's focus box in 2025 noted official sector demand at record highs, accounting for 20% of global demand, double the decade average. Demand collision intensified the pressure. Industrial uses alone grew 5 to 10% annually. Electric vehicles incorporate gold in battery management systems and sensors. Solar energy, booming with global net zero pushes, uses gold in photovoltaic cells for efficiency. Military tech, from drones to satellites, relies on gold's conductivity in extreme conditions. Power grids, upgrading for renewables, employ gold in transformers and switches to minimize corrosion. AI data centers, exploding in number, use gold in high-speed connectors to handle massive data flows. These aren't optional, they're infrastructure imperatives. Governments subsidized them, corporations invested billions. They bought gold regardless of price, creating inelastic demand. Banks' reaction, or lack thereof, sealed the shift. Traditionally, when gold rallied too far, central banks like the Swiss National Bank or IMF would sell to cool markets. Not in 2025. Silence prevailed. The Fed, focused on domestic inflation, didn't intervene in bullion. Emerging market banks complied with internal mandates to build reserves, ignoring spot volatility. This non-action was the regime change. Trust in the system eroded as physical access tightened. Once thresholds break, like delivery failures hitting critical levels, reversing becomes impossible. Suppliers exhaust stocks, buyers hoard, and prices reprice to reflect true scarcity. We've seen parallels. The 1971 gold window closure ended dollar convertibility, triggering a decade-long bull market in gold. Similarly, the 2008 liquidity freeze saw gold as a haven amid bank failures. The 2020 repo panic briefly spiked gold before central bank interventions. But this time, the banks themselves are the buyers, not the stabilizers. The real question lingers. In a repriced world, who gets the gold? Institutions with vaults? Nations with mines? Or retail investors scrambling late? Markets signal quietly. This cessation of sales was one such signal, a precursor to the final repricing. To delve deeper into the hidden moves that amplified this dynamic, we turn to the specific actions of key players. The National Bank of Poland led the way in 2025, adding 83 tons through October alone, pushing its reserves toward a higher target share without public fanfare. Kazakhstan followed closely with 41 tons, sourced through domestic production and quiet market acquisitions. These were not isolated decisions. The People's Bank of China reported modest monthly additions, 5 tons here, 2 tons there. But the pattern extended across multiple quarters, resuming a streak that signaled ongoing commitment. Turkey's central bank incorporated 3 tons in October, part of a broader strategy that included treasury holdings. Even Brazil returned to the market after years of absence, taking delivery in Q3. Not announced, not explained, but irreversible. One action. Steady, unreported accumulation by multiple institutions. One consequence, gradual removal of tons from the open market, tightening the pool available for private buyers. This wasn't a coordinated announcement. No joint statement from the BRICS nations or emerging market forums declared a halt to sales. It simply stopped. The last central bank gold agreement, which had governed limited sales among Western banks, expired years earlier without renewal. Traditional sellers, the IMF, the Swiss National Bank, even occasional European holders, remained silent. No auctions, no offloads to fund deficits. Instead, the flow reversed entirely. Data from the World Gold Council through Q3 showed net purchases of 634 tons year to date, with October adding another 53 tons. Reported figures likely understated the total. Surveys indicated many banks buy discreetly, reporting later or not at all. The 2025 Central Bank Gold Reserve Survey revealed that 95% of respondents expected global reserves to rise further, with 43% planning increases for their own institutions. Gold's role as a hedge against sanctions, inflation, and currency risk drove this shift. On screens, gold traded above $4,200 per ounce by December. In the real world, physical delivery faced growing friction. Premiums in Shanghai hovered between discounts and modest upsides early in the year, but festive demand in India pushed them to $25 per ounce in October, levels not seen in over a decade. Dealers in Mumbai and Hong Kong quoted wide spreads, reflecting localized shortages even as global spot prices soared. Refiners reported backlogs. Large bar availability tightened for institutional buyers. COMEX inventories swelled to record highs, over 43 million ounces at points in the year, driven by tariff fears and arbitrage pulling metal into U.S. vaults. Yet this masked strains elsewhere. London vaults saw outflows, with withdrawal delays stretching weeks. Asian markets absorbed the rest, where cultural and strategic demand overlapped. Inventory disappearance wasn't dramatic overnight. It built gradually. This would be manageable if demand were falling. But it isn't. Industrial uses continued their steady climb. Electronics and EVs and renewables required gold for reliable contacts. Solar panels incorporated it for efficiency. Military systems demanded it for corrosion resistance. Grid upgrades and AI data centers used it in connectors and plating. Central banks themselves absorbed a growing share, estimated at 20-25% of annual supply in recent years. These systems don't wait for price discovery. They procure what they need at whatever cost, because alternatives don't exist at scale. The insider moves extended beyond buying. Many banks repatriated gold, bringing it home from foreign vaults. India's Reserve Bank increased domestic storage to over half its holdings. Poland held most onshore. This reduced lendable supply in global markets, as repatriated metal sat idle in sovereign vaults. Silence from potential sellers reinforced the shift. No major Western bank announced sales to capitalize on highs. The Fed held steady. The ECB focused elsewhere. This non-intervention marked the change. Position changes, exclusive net buying across emerging markets. Silence from historical sellers. Rule change, no new agreements to cap or coordinate sales. Sudden compliance with internal diversification targets. The cracks widened quietly. Dealers reported longer lead times for kilobars in Asia. Coin premiums in the West rose as mints struggled with demand. ETF holdings grew, but physical backing required sourcing from tightening pools. Once certain thresholds cross, when annual absorption exceeds new supply consistently, the system can't revert easily, not because of price alone, but because of allocation. Supply exhaustion in accessible stocks, delivery friction in key hubs, political resolve to hold, not sell. We've seen parallels before, though not identical. The 1970s saw Western sales give way to private buying amid inflation. The post-2008 era flipped central banks to net buyers after decades of offloading. But this time, the buyers are the guardians themselves, and they're not selling back. The real question sharpens. When access tightens further, who secures the remaining physical supply? Institutions with established channels? Nations with production? Or those positioned early? Markets signal quietly through actions, not words. The absence of sales amid relentless buying was another such signal, pointing toward a repricing not just of price, but of availability. As these hidden accumulations compounded, the disconnect between paper markets and physical reality became impossible to ignore. On screens, gold hovered around $4,200 per ounce through much of late 2025. In the real world, physical access began to fragment in ways that spot prices no longer captured. Premiums in key Asian hubs told the story first. In Mumbai, dealers charged up to $25 per ounce over domestic benchmarks during October, a festive season, the highest in over a decade, as importers scrambled amid surging cultural demand. Shanghai premiums fluctuated but trended higher in periods of tight supply, reflecting localized strains even as global inventories appeared ample. Delivery delays emerged quietly. Major refiners reported extended lead times for kilobars and large bars, stretching to weeks in some cases. Vault withdrawals in London faced backlogs, while Asian markets absorbed metal at accelerated rates. Trading halts occurred sporadically on futures exchanges amid sharp volatility spikes in October and November. Premium spikes became routine in retail channels. American Eagle and Maple Leaf coins carried markups far above historical norms as mints cited allocation limits. Inventory disappearance wasn't uniform. COMEX vaults swelled to over 36 million ounces by December, driven by arbitrage and precautionary inflows, but much of this remained eligible, not immediately registered for delivery. Registered stocks, the portion available for contract fulfillment, fluctuated lower at critical points, raising eyebrows among traders monitoring potential squeezes. This would be manageable if demand were falling. But it isn't. Central banks absorbed an estimated 634 tons through Q3 alone, with October adding another 53 tons in reported buys, figures likely understating total official sector intake. EVs incorporated gold in advanced electronics for battery management and sensors. Solar installations demanded it for conductive efficiency in panels. Military hardware required it for reliable performance in extreme environments. Grid expansions used it in high reliability components to support renewable integration. AI infrastructure scaled rapidly, embedding gold in high-speed connectors and cooling systems for data centers. These systems don't wait for price discovery. They secure supply chains proactively, bidding whatever necessary to meet build schedules and mandates. The bank reaction, or its absence, highlighted the shift. This is where institutions usually step in. They lease metal. They intervene to smooth extremes. They restore confidence. This time they didn't. Position changes. Emerging market banks continued exclusive net accumulation, with Poland reaching 83 tons year to date and Kazakhstan at 41 tons. Silence from Western holders on any sales to ease pressure. Rule change. No coordinated efforts to release stockpiles, unlike past cycles. Sudden compliance. Repatriation trends accelerated, locking metal in sovereign vaults unavailable for lending. Once physical premiums sustain above certain levels consistently, indicating persistent allocation friction, the system can't fully revert. Not because of price alone, but because of demonstrated scarcity in channels that matter. Supply exhaustion in open market flows, delivery friction across regional hubs, political commitment to retention over recycling. We've seen echoes before. The late 1970s bull market featured similar divergences, where official inaction amid inflation allowed physical bids to pull prices higher. Post-2008, initial ETF surges masked back-end strains until resolved by mining supply. But here, the official sector itself drives the structural removal, without counterbalancing sales. The real question grows clearer. When physical channels tighten further, who retains priority access? Established sovereign buyers? Industrial giants with long-term contracts? Or late-arriving private participants? Markets signal quietly, through widening spreads and lengthening queues. The growing gap between quoted prices and actual acquisition costs was another such signal, marking the onset of a repricing defined not just by dollars, but by availability. With trust in seamless delivery eroding and thresholds quietly crossing, the system approached a point where reversal grows improbable. This is where banks usually intervene. They cap the move, they calm the market, they release stockpiles or coordinate with producers to ease supply concerns. This time, they didn't. The shift began earlier in the decade, but solidified in 2025. Central banks, once periodic sellers under agreements like the expired central bank gold agreements, became exclusive net buyers. No major Western institution announced sales to profit from highs or stabilize volatility. Emerging market banks accelerated accumulation, with the National Bank of Poland leading additions and others like Kazakhstan and Azerbaijan following. Silence dominated from traditional holders. The IMF reported no significant offloads. The Swiss National Bank remained quiet. The Federal Reserve held its positions without intervention in bullion markets. Position changes. Net buying persisted, with reported year-to-date purchases reaching hundreds of tons despite elevated prices. Silence from potential sellers. Rule change. No renewal of sales caps or new coordination to flood markets. Sudden compliance. Repatriation continued, with more banks storing onshore, removing metal from lendable pools. On screens, gold surpassed $4,400 per ounce by late December 2025, briefly touching above $4,500 amid thin holiday liquidity. In the real world, physical premiums widened further in key regions. Asian markets saw sustained markups as importers bid aggressively. Retail channels in the West faced allocation limits on coins and small bars. COMEX inventories hit record highs earlier in the year, over 43 million ounces at peaks, driven by precautionary inflows. Yet registered stocks for delivery fluctuated, and regional strains persisted elsewhere. Delivery delays lingered in London vaults. Refinery backlogs extended into weeks for certain specifications. This would be manageable if demand were falling, but it isn't. Central banks added robust tons through the year, with Q3 alone seeing over 200 tons net, and October rebounding strongly. Industrial procurement accelerated, EVs scaled production, solar deployments expanded under subsidies, military contracts demanded reliable components, grid upgrades incorporated high conductivity elements, AI data centers proliferated with massive buildouts. These systems don't wait for price discovery. They fulfill mandates and contracts, sourcing metal at prevailing costs, because substitutes remain inadequate. The point of no return nears when certain thresholds break. Once annual official sector absorption consistently exceeds a significant portion of new supply, combined with inelastic private demand, the allocation mechanism changes permanently, not because of price alone, but because of trust. Trust that paper claims equate to physical claims without friction. Trust that global markets remain integrated and liquid. Supply exhaustion in accessible lendable stocks. Delivery failure risks rising in fragmented hubs. Political interference. Export controls from producers. Sanctions reshaping flows. Diversification mandates locking metal away. We've seen this before. Not exactly in gold's modern era, but in the 1971 closure of the gold window when official convertibility ended and private prices exploded higher, similar to the 2008 freeze where liquidity vanished until interventions restored flow. But here, the interveners are the accumulators. The question isn't if the price moves. It's who still has access when it does. Sovereigns with vaults filled quietly over years, industrials with entrenched supply chains, or those relying on open markets now tightening. Markets don't announce resets, they signal them quietly. The cessation of sales, replaced by relentless buying amid scarcity signals, was one of those signals. A regime change, not in rhetoric, but in behavior, triggering gold's final repricing from commodity to strategic necessity. As precedents echo and inevitability sets in, the outcome crystallizes, not in speculation, but in the quiet actions already taken. We've seen this before, not in gold's recent cycles, but in the 1971 closure of the gold window. In August of that year, President Nixon suspended dollar convertibility into gold, ending the Bretton Woods system overnight. Officially, it was a temporary measure to stem reserve outflows. In reality, it marked the point where trust in unlimited fiat expansion fractured. Gold prices, previously fixed at $35 per ounce, were freed, and within a decade, they multiplied more than 20-fold. Similar dynamics played out in subtler ways during the 2008 liquidity freeze, when counterparty risk exposed vulnerabilities in paper claims, driving flight to physical assets. And in the 2020 repo panic, central bank interventions briefly stabilized markets, but gold emerged stronger as a non-counterparty hedge. This time, the shift is driven by the guardians of the system themselves. Central banks, having absorbed hundreds of tons in 2025, with Q3 alone seeing 220 tons net, and October adding 53 tons, have not countered the rise with sales. No major Western institution offloaded to cool prices. Emerging market buyers, led by Poland, Kazakhstan, and others, continued accumulation even as spot surpassed $4,000 per ounce for the first time. On screens, gold approached $44,100 by late December 2025, with brief touches higher amid thin liquidity. In the real world, physical premiums persisted in regional markets, reflecting ongoing allocation pressures. COMEX inventories remained elevated from earlier inflows, yet global flows favored sovereign vaults and private hoards. This would be manageable if demand were falling, but it isn't. Central banks added robust volumes through the year, with year-to-date figures through October at over 700 tons in reported nets alone, underscoring strategic intent. EVs scaled with gold and critical components. Solar deployments grew, embedding it for longevity. Military systems relied on its reliability. Grid modernizations incorporated it for durability. AI expansions demanded it in high-performance infrastructure. These systems don't wait for price discovery. They build, procure, and secure, regardless of quoted levels. The point of no return arrives, not with fanfare, but when thresholds break irreversibly. Once official sector absorption locks in a structural share of annual supply, combined with inelastic industrial and investment needs, the repricing becomes embedded, not because of price alone, but because of trust. Trust in frictionless access, trust in paper equivalents, supply exhaustion in open channels, delivery commitments honored without delay, political directives prioritizing retention. The question isn't if the price moves, it's who still has access when it does. Sovereigns that accumulated quietly through the cycle, industrials with secured contracts, institutions positioned in physical form early, or those arriving as channels constrict. Markets don't announce resets, they signal them quietly. The halt in sales, replaced by persistent buying amid elevated prices and tightening realities, was one of those signals. A precursor to gold's final repricing, not merely in dollars, but in its role as the ultimate neutral reserve in a fragmenting world. If you're watching this, you're early.